I'm with the Texas Note Company, and a lot of you I recognize here from other various networking functions, and I've worked with you, so I'm really happy that you're here today. I hope that that you get something out of what I'm going to talk about today, which is really the gold in the paper. And really all that is, the gold in the paper is the details in creating the note. You know, details, details, details. As we go through the different places, if y'all have any questions, please jump in and say, I don't understand, or can you explain that further? The introduction, I'll talk about the promissory note, payer credit, transaction documentation, and professionals. That's, you know, more or less the agenda. So, start off a little bit about me. As I said, I'm the founding director of Texas Note Company. I spent 10 years at Dell. I paid freight bills. I was, you know, that was like 600,000 freight bills a year and distributed over $700 million for Dell each time. So those numbers are huge, but that's just the way Dell is. I did a lot of data analytics for them in their finance, so the loan servicing that I do, I agreed to do that because of that experience that I have behind me. I also spent 5 years at Citibank, where I worked in their business and professional department, where we offered loans to businesses, you know, in Maryland, New York, and wherever they had the bank, all over the place. That was quite a long time ago. I have two wonderful girls, Catherine and Caroline. You know, they...
Can you check and see if that's obstructing their view?
Oh, can you see that? Oh, okay. Is that better?
Yeah.
Okay. 9 and 5, there they are, and they're two little poodle skirts before we went to Hill Elementary dance one night. I'm a Hill Elementary Dillo dad. What that means is I help around Hill Elementary, you know, rake the leaves, fix the doors, whatever they ask me to do, I do it, along with a bunch of other Dillo dads too. I'm also the head coach of the Porcupines, and the girls play kickball, you know, at the Northwest Austin on the far west, and believe me, that's a lot of fun. The girls do that. So that's basically me. In order to turn paper into gold, you really need to look at the details, and they need to be accurate. I can't say that enough. You know, I'm involved in a transaction that I'm going to close today at 3. And there was a $30,000 hickey because the person who put the documentation together didn't pay attention to the amortization and the balance of the note. Now, that turned around was good for one side, the actual payers, because their principal balance went down. But the person trying to sell a note, when we put everything together, his expectation was a different number than what he got. Had he, you know, paid attention to the details when he put together back in 2006, he'd be $30,000 richer, so to speak. And even I missed it, so I, you know, kind of blew it a little bit on my commission. I had to take a hickey because of that. So, in this business, you know, that turns out to be bad notes. If you make a commitment to avoid those errors, it's really going to help you and your customers out in the long run. That deals with the details of creating the note, the insurance part of it, all encompassing, especially when you're dealing with wraps. So what I'm going to get into here is just the different things of what I think, if you're going to create a note, whether it be a wrap or just a straight owner finance note, what I would look for if I'm trying to sell it for you, what investors want to do. So you want to create a note that investors have in mind. So if you get somebody to say, hey, I want to sell this house, I'm going to put a wrap on it, and then I want to turn around and sell the note, get my money on it, pay off the first thing, you need to pay attention to what's going on right here, because that's going to be some of the pitfalls, because you're going to have to find the right buyer. So I don't know if this will do, okay, yeah, down payments. One of the biggest mistakes that people have done and when they create a note is they say, okay, we'll take, you know, a small down payment. You know, that creates protected equity in the note that you do. That, if you have a small down payment or no payment, and you try to sell that note to an investor, the investor's going to go, wants to keep that payer from just being a flight risk and all of a sudden stop paying it. As opposed to somebody who puts 10, 20, 25% down, which is $20,000 or $30,000, that's protective equity. The investor looks at it as like, hey, that's good. This guy is a lot less likely, and the statistics show it, that will make his payments in the future. Because the investors that I work with, they don't want to foreclose on these properties. They want to be able to get a future cash flow that they can get the return on their money, usually 15 to 20%, and know that that payer is going to make those payments. Now, mitigating circumstances, especially in this economy, certainly happen. So, but the larger the down payment, the better off you're going to be. And I always go, if you can get a 20% down payment and you want to sell your note, get it. Just go for it. That's what you really want to try to do. 10% is okay, usually by investable, but it's just that. It's okay. When you look at the numbers and everything else, you're not going to get as much money when you sell that note on the secondary market than you would if you'd have 20% down. Now, the other mitigating factor to 10% down, if that note had an original down payment of 10%, but it has 2 years of payments on it, of on-time payments, then that is good as well too. Amortization. This is always a little bit of a tricky one, depending on, because there are different note investors who, some of them like balloons that last them 5 years, some of them don't like balloons at all, but really this rule of thumb is to keep it simple. Try to do a straight amortization, 20 years or less. You know, it could be 19, 18, 17. When you say 30 years is a long time. And people's objectives change. So the longer, statistics show that the mortgage notes, you know, traditional owner finances, all included, the lifespan of those is about 7 to 8 years. So that means that the buyer of the home will turn around and going to sell that home in 8 years or whatever it means, so it'll be refinanced off. So it's not as big. But unless you have a clear exit strategy, when you're dealing with balloons, know that you know, extend the balloon out past 5 years. Do 5, 6, 7 years and give the economy or somebody to refinance time enough for that to happen. Now, I'll caveat that a little bit on wraps. Wraps is a completely different story. And Kelly and I had this discussion where first position liens when you're doing a wrap. Banks aren't stupid. You know, they know that the wraps are happening. And the due on sale clause that's in there, I wouldn't be as worried about that. But when the foreclosure business ends for banks, when it doesn't become their top priority, going to court, dealing with all those foreclosures, then they're going to go on to something new. And the first thing that's going to happen, in my opinion, is that those banks are going to come to wraps on their low interest loans. So if somebody has a low interest loan, 3, 4, 5%, that's involved in a wrap where they're paying on it, that'll be the first one that they, you know, turn. And I think the time span on that is around 3 to 5 years. So I would be safe to say that, you know, put a balloon in place about 5 years. Alan?
So how are the mortgage companies going to know that their product has been wrapped?
I don't know specifically on how they're going to know it. Like if they have a loan servicing company and the check comes from the Texas Note Company and some whiz guy there. Also the insurance company.
Insurance.
As Kelly, yes?
All we got to do is give the list of property addresses for the leads and tell me review to go to the courthouse.
Yeah.
There's 254
look for
counties in
title
Texas.
transfer. Look up every one of these addresses, see if there's a title transfer.
See, and I've been wondering if they're going to actually do that or not. There's 254 counties in Texas.
I'm sorry?
There's 254 counties in Texas. There's 50 states. How much would it cost for a city group to do that?
Right. Well, you know, as I said, when they're done with the foreclosures, at the volume that they are now, they're going to still have people on staff and they don't necessarily want to let go. Hey, why don't you tackle this? And, you know, just like me as a note finder when I'm brokering notes, looking for notes to see if they want to sell them, you know, I just go online and, you know, go through all the county records and you just, you know, pay your $35 fee and say, oh, okay, when you look up the records like in Travis County, you can go down to, I forget who the grantor and the grantee is, but one side has a list of banks. The other side has a list of names. Well, you go down the list of banks, all of a sudden you see somebody's name. That's an owner finance note. Well, let's take a look at that. I mean, there are a bunch of different ways to do that.
So one of the scenarios that came up recently with the bank that we were working with is that the bank was in distress, and so the FDIC came in and they audited the bank, and they found notes that were wrapped, and so they went after those.
Yeah, I mean,
That's why I keep them short, like you say.
yeah. But the other thing is, like Kelly points out, they'll find out through the insurance company. So say, some of the homes that I have that I'm servicing from a loan owner finance or for loan servicing, one of them's up in Fort Worth, and they had a little tornadic damage, and they went to make a claim, but yet the original policy was in the seller's name, so the seller had to make the claim, and it was just, kind of a sticky thing. But when something like that happens, they're going to make a claim, they're going to bring it up, the bank's going to go, oh, what's going on here, and ask a few questions. So there are ways of how they're going to do it. I really don't know. Any other questions on the term of the note? As I say, I like things that are 20 years and less, especially when I go to sell them. I don't mind amortization for 30 years with a balloon and 5, because some people need to work the payment down. Okay, interest rate. Now this is my favorite one. I get a lot of pushback on this one. Now, interest rate, essentially, that sets the value of your note right there. That's the most important thing, is the value of the note. If you put a 4 or 5% interest rate over 30 years and then you get upset, when I turn around and say, okay, I'm going to give you 50 cents on the dollar, don't get mad at me. You're the one who created the note. If you want 5% on your interest on your money, that's one thing. Then, enjoy your 30 years of 5% interest. Given that, I also say that, most people who do owner finance are not banks. So don't kind of be, my advice is, don't offer what the banks do. Banks aren't lending their own money. They're lending the federal government's money, Freddie, Fannie, and Freddie Mac, or whatever they are. They're lending their money at those low interest rates. But if the banks were to lend their own money and be forced to do that, the interest rates would be 9, 10, 11%. So I suggest that you do anywhere between 9 and 10%. Now there are a few people in this room that I've had discussions with, as well as others that says, oh, anything above 8%, I just don't feel right doing that. Well, a higher interest rate does a couple of different things. It gives you a higher value on the note when you go to sell it on the secondary market, because investors want a 9 to 15% return on their money. So they're going to buy that note at a discount. In order to get to their 15% in discount, that means you take the principal down and discount it a little bit more for what they're looking for. So if you already have an interest rate from 9 to 10%, that means your discount is going to be less, more money for the seller. Everybody with me on that?
How do they determine the end point?
The end point of what?
15% in 2 years, 15% a year. So you have an end point down there. It's not all interest return. How do they determine?
Well, you led me right into my next slide. I didn't have an example of that. Okay? So here's an investor, and I got the yes in the wrong place to fix that. He wants 15% annually on his money. So you go to your TI financial calculator, you put in a present value of $100,000, your term of 120, which is your in, and then interest rate 7%, you calculate, that gives you your minimum payment. Okay? That's, $100,000 note over 10 years, 7%. Now, if the investor that are going to sell it, just say that, for argument's sake, that is the balance on it. If they want 15% return, their offer to the seller is going to be $72,000. And that's with a 7% interest rate. Conversely, if you take the same $100,000, but yet you offer 10%, you're going to get $10,000, that seller's going to get $10,000 more. That's a lot of money. And that's where the interest rate, now, not only does the secondary market offer, do you get more money out of your note when you have a higher interest rate? The other thing the higher interest rate does is when the buyer accepts that 10% interest rate, that means that's a lot more incentive for him to go and get refinanced. And then the seller really is in good shape, because if he gets refinanced, he gets his whole principal balance back. So I always encourage folks to do 10% interest rate.
Now, how long should you let this season before you would offer to sell?
It depends. There are a bunch of different ways of looking at seasoning. And the example I always like to use, what note would you buy? Here is a note that, is $100,000, or let's say it's $120,000. They put $20,000 down. There's 12 months of payments. 6 months of those payments are all late, 30 days or greater. And right now they're one payment behind. Take another note, same note, $120,000, $20,000 down. You check the person's credit at 600, they pay their bills and everything else, there are only 2 payments there. What note do you want to buy?
Second.
The second one, absolutely. And that's, that's kind of common sense. So you got to turn around and evaluate each and every note on all these different variables that were going on there, payment history being a very important one. Payment history, that's where you get back to the 10% down payment. I'm very okay, which is really good English, with a 10% down payment if, there's 2 or 3 years of payments on that note, okay? And they're on time, because there's nothing better. I can sell that at the top dollar every single day if you have a payment that a note that shows all the different payments and 10% down. Now, some of you have heard this story I'm about to tell. I tried to sell a note in Port Arthur. The guy, his name is Pastor Sweet. That was his note that I was going to sell. And he had down in Port Arthur, he had a house that got wiped off the slab by Hurricane Ike, okay? He went to court on the insurance part because the insurance company said that, well, it wasn't the hurricane that, wiped out your house, it was a tornado, and he didn't have wind insurance. So he went to court on that, lost, and ended up getting a foreclosure on his credit report. Now, most of the investors around the country wouldn't touch that with a 10-foot pole because it shows a foreclosure on his record. Okay, now what I did, and where the Texas Note Company, I think we have an advantage, is most of the people that I look for buyers of notes. Certainly I have all the national ones that I sometimes present to, but really local investors. And Mr. Sweet had a good story. Now the other thing that he had is he had a note not too similar, not too far off this one, $100,000. He had about 10% down payment, but he had a great story. The other thing is he pays bi-weekly. And he had 4 years of bi-weekly payments, every single one of them right on the nose. A great history. Now his credit, when we pulled it, it was right under 600, so there are a couple other things, but his note was right on line. So with an investor who will listen to that, a good story, that goes a long way. Late payment clause. This is another big one that you'd be surprised of all the notes that I've seen, how often this is left out. Which is, in the loan servicing world, it kills me because, part of the fees that we generate, we get 50% of the late payment fees. So I always go back and say, is there a late payment clause on it? They said no. So always include it, just because, you want to be able to protect yourself against, yourself being the person who's creating the note, against financial loss. You got to have some sort of leverage to do that. Now, a lot of people use the notes that I've seen. They use the standard late payment clause that says, okay, we'll charge you 5% or 10% over 10 days after the 10th day. That's fine and dandy, but make sure it covers your objectives. It's just one of those points when you're working with a client or whatever. Okay, let's talk about the late payment clause. What do you need that to be? What are some of the circumstances that can happen over that? So with that being said, let's move into the RAP's late payment clause. And here we go. There are other details to consider with a RAP late payment clause when you're doing that. And a lot of the RAPs, and Alan, this is good for you here. Most payments are due on the 1st, okay? Let's say that there is, and this RAP concerns with also being a loan service provider in the middle of it. And payments due on the 1st. The first lien is also due on the 1st, but its late payment clause, the absolute last day that most liens at Citibank, Wells Fargo, is due the 16th, okay? So if you create the RAP note standardly, like most are, it says, okay, let's do 10 days, and after the 10th day, which is actually the 11th day of the month, we'll charge a late payment penalty. Well, there are a lot of people I've come to find out that, really, I don't want to say abuse, but they use their grace period, substantially. So if they make a payment to me, the Texas Note Company, on the 10th day, just say they did that, and by check, I have to hold that check to validate funds for 7 days. So plus 7. All of a sudden, I'm to the 17th. Now you know what happens on the 17th?
You get a late payment on the wrap.
Right? So who's responsible for that?
Seller.
The seller.
The underlying bill.
Exactly right. So the buyer, the new person of the home who's paying on the wrap loan, he is contractually in his right to go ahead and make the payment on the 10th day. He's okay. He doesn't get a late payment fee, he doesn't get anything. But the grace period here that I've got to validate the funds that they're okay before we pay it puts that after the 16th. And you know, I've got 15 of those particular circumstances that I get calls about every month where all of a sudden the payer makes that payment, it's late at the first lien, and the seller of the home is not very happy. Yes.
Can you, in your note, would you suggest, or can you suggest that the payment be made by electronic funds? Do you accept electronic funds?
Yeah, I mean, certainly. You know, that's the way we prefer to do it because, hey, that's less money for me to process.
Well, and then you don't have to wait for the clearinghouse.
I still do have to wait for the clearing, but it's 4 days.
Okay.
So if I do automated clearinghouse, which is a service I provide, you know, I'll pull it on the 1st, on the 5th. This month it was on the 6th because the 5th was a Sunday. I was able to get the report back from the bank on which one NSF.
So if it's an electronic transfer, it's money to money, it's bank to bank.
Yeah, but in this
Why are you
case,
waiting 4 days?
it's a check.
No, I understand
Yeah,
that.
yeah.
What I'm asking you is if I were to pay you from my bank account to your bank account,
Yep.
it's not coming out of my account if I don't have it.
Right?
Okay, then do you still have to wait 4 days?
It's
Yes,
same,
I do,
it's same
because
day
I have-
transfer if it's the same institution. If it is another banking institution,
Right.
it's not yours, it's still a 4-day lag time before funds are processed and deposited.
It's a 4-day lag time for them to come back and say, hey, these funds, there wasn't enough in there, they've been assessed.
Okay,
So,
I
and that's why I have to wait. That's why when I make my distribution payments to all the first liens, it's on the 5th, 6th, 7th of every month. And that's very important to many people like Michelle and I talked about this earlier this morning, where I just, you know, I had to send a welcome letter to her to explain that process to her and how that works. Once they understand that, especially if they understand going into a wrap situation, that's how it works, then everybody can get on the same page. But it's definitely a pitfall where sometimes it can really hurt the seller and, you know, frustrate the heck out of them. Any questions on that? Did I cover that well?
Very well.
Okay. Accounting in the know. Well, as a loan service provider, I can guarantee you that we'll provide accurate, very accurate accounting, and if there's something wrong, we can correct it and determine it very quickly. But the accounting in the note, when you go to sell it, is extremely important because at this day and age, I mean, 6 years ago, some of the note buyers, they didn't really care, you know, because AIG, which we all know was a big, huge buyer in the secondary market through their subsidiaries. And they were just funneling all sorts of money, and basically you had to give them the docs and no really proof of anything, and the deal was done. It was very, very easy. But as soon as AIG went down the tubes, that whole market really got tight. And all the other investors like, well, I want to see payment history, I want to see the credit. I mean, they just go through a whole list of items that we wanted to see. And if, you know, a lot of mom and pops who create owner finance deals on their own on a napkin or a piece of paper, they don't think, you think they're going to keep accurate accounting records? My very first note deal that I did, guy up in Garland, Texas, he ran an auto business, and his cousin had a record business. And I guess he had written the note to his cousin, and all their transactions, every single one of them, both his transactions and his cousins who ran the record, were all in cash. So every time that his cousin would make a payment to Tom, was his name, he just deposited it with all the rest of his cash. There was no way for us to validate the payment history. And the buyer's like, hey, Robert, you know, I've seen this before, but there's no way we can do that. You know, we can't figure out how to, validate what they're saying. They're not in cahoots, creating a fictitious note. And so what I found was a way to get around that. Something that I found, the payer on the note was the cousin who had the record service. You know what the most important thing to that cousin was? That truck. That truck, that, $100,000 vehicle that he has, it was a big, huge one that he sent me a picture of. I said, go get in Jose's, go get his statement from his auto loan dealership and everything or whatever, and show me all the payments that he made on that truck. Every single one of them was on time. And every single one of them was a money order because I turned around and called GMAC Auto Finance just to validate that. So I was able to get that note sold just because being a little creative on my part to find some sort of payment history that validated what these two guys said. So the best thing I can say to most of y'all people, be your customers, when they have, they're going to do it themselves, either get a loan servicing company like us, or they're going to do it themselves, document the payments. When the payments coming in, keep the canceled checks, get a separate banking account to where only the transactions that deal with that note are in that account except them withdrawing the funds. Funnel every single thing through that. Because then when I turn around and, hey, I need to see your payment history, all they got to do is go to the bank, print a deposit report, go, here, Robert. And I've had several people do just that, and it makes life a lot easier as opposed to going back to the payer. Hey, do you have your canceled checks for all this? Can we show you different checks? Which just gets to be a real big mess. But accounting is one of the biggest things that's often overlooked when people create owner finance notes. That's another big kind of thing of gold in the paper. The details. Always run the numbers.
Robert, I had a question before you proceed. On the accounting, how do we claim that interest?
How do we claim the interest?
Yeah.
Good question. The way the interest is done is through a 1098 or 1099. And the software that we use at the Texas Note Company, I just push a button and boom, it produces a report. But if you're doing it manually, you have to calculate on an amortization schedule how much interest has been paid. So here's my principal and interest for month one, and then how that adjusts each and every month. And you'll do it something like in Excel that offers that standard amortization schedule there. And then you just add it all up, put it on your 1099, 1098, boom, there you go. That's the way to do it. Did I answer your question?
Yes, sir.
All right. The details. Now this is totally where the gold is, and as I say, the deal that I'm closing a little bit later this afternoon is precisely that. Always run the numbers. Have a second set of eyes run the numbers and make sure you come up with the same thing. Because the thing that will cost you, most of the people that work in this, that I see in this room are going to be based off commission. And if the numbers are wrong, that means your commission is going to be affected. Just make sure that it's right, because that gives you credibility. It saves you money, saves headache that all of a sudden either the buyer or the seller is like, how did this happen? Blah blah blah. And I've seen it several different times that happen. The details, details, details. I mean, that's what it really is, and it just sometimes you got to stop and say, okay, what are all the main variables of this promissory note that I'm putting together? How do I punch it into the calculator? Your term, your interest rate, the payment amount, the maturity date. That's another thing. When you create a promissory note, make sure that you have who the buyer and the seller is, or the maker and the grantor and the grantee, the trustee, all the names, their addresses. Make sure that there's a maturity date on that, and if there's a balloon, don't say that, here's a 360-month note that's due 2012 in June. If somebody like me trying to process it, I'm like, well, how did you come up with this payment number? If it's, if it matures, in a year from now, and we have this, then I have to guess and go back and say, okay, looks like the payment they had goes to 20 years out.
So sometimes I'll have someone that wants to have the payment track exactly the underlying mortgage. But they're actually charging them higher interest, and they're going to get their dollars whenever it refis or sells. And I know we've sent one over to your place and it caused some confusion. So I guess I'm asking, how would you want me to gear that so that it's easier for your side?
I would really prefer that you create those, when you create a note, you create it separate from the existing lien that's on that property. Okay? So you're going to sell that property, you're going to sell it, say in that case that we have, you're going to sell that property for $150,000. Okay? You're going to put, $15,000 down, so you have $135,000. Your interest rate's going to be 9%. And then just boom, 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 and then that payment, you calculate that payment. Okay, this payment is going to be, say, $1,000. Well, the first lien payment is $980, so you're covered. So you have a bit of a 20% spread. As long as you cover your first lien.
What they're doing though is they're saying, yeah, you do owe me the $1,000, but I'm just going to take the $980 for the life of this note,
right,
and then I'll get my extra $20 when it refis out. So they're not requiring them to comply with the amortization schedule if you plug those numbers in. Right. They're actually hard coding the payment in there at less than what the amortization table would show.
See, you're opening up yourself really to a lot of criticism there, because really you want to have those numbers. Because what's going to happen in 3 years? They're going to come back and say, "Oh, is that what we said? Well, you can just keep that extra $20. I could use that $20. You owe me all this money." I'm just trying to think of what it'd be down the road.
I try to educate them out of it.
Yeah.
But it's not my job to.
If the note's sold and they're required to make $1,000 a month payment, but then he buys the note, and now all of a sudden he receives $980, but he's looking at the AM schedule and it says $1,000.
Yeah.
They're short, and they're going to be late.
Well, they're not short because the promissory note hard codes the payment that's due.
Well, then just rework the AM. Rework the whole thing.
I prefer, from a loan servicing standpoint, not to do it that way. Just because everything you give me, I run the numbers.
Right.
And then I turn around, I come back and go, "Alan, something's not adding up here. Why is that happening?" And so I'll hear that, and then once I hit it, I can adjust as necessary. But the way we work it, we calculate that payment based on whatever the maturity date is, and the software does it. Says, okay, that payment's going to be $980 or $1,000. The first lien on that is going to be $980 every month. So I'll take that. So I end up with a $20 amount there. Well, I'm just going to send that money to the seller. They're going to actually cash flow on that transaction. And that's a very nominal amount. But you can work your numbers to, when you take the financial calculator, you have those 4 variables. You got the term, interest rate, payment, and present value. So just put the payment in, put the term, what it should be, interest rate, then compute for present value, and that's what you can put on the note. So you just kind of, rather than kind of do it the way we all normally think about it, just do it a little bit differently. And then that way, when you run the numbers, you're spot on. That's real important, because that eliminates any sort of discussions, down the road, because that's usually where those come back to kind of cause confusion and say, okay, what we were thinking 6 years ago when we put this note to here or whatever it was, how did we end up with this number here? And if it's not explicit, then that's going to leave everybody guessing and assuming, which is what you don't want.
I may use you as a voucher for what I'm telling them.
That's fine. I will preach that all the time, because, as I said, I have this transaction today that's driving me crazy, because, nothing against attorneys. His attorney didn't run the numbers, and if he did, somehow he got it wrong. I actually know what he did, because I was able to read enough of the document, because there were 2 notes involved, and he added them together and came up with the principal balance, and then he just overlooked it. And then everybody, including the buyer and the seller of the note on this transaction, everybody overlooked it. Everybody did. So, and it created a lot of confusion over the past week.
And that didn't come out of my office.
No,
right?
it didn't.
Good deal.
It didn't come out of anybody that I work with here right now.
And if I can say something, as far as everybody wanting to do this, have your team, your attorney, your accounting, anybody that you're going to be working with, they know what they're doing in this business. Because I can tell you, I just went through this. I went through 3 attorneys here in Austin that had no idea of what we were doing. And so it's important that people know what they're doing.
And that goes right into what I'm talking about. title companies. Harold and I were speaking a little bit earlier this morning about title companies and who to use that does owner finance transactions. Because there's a lot of details in those things that if you just go do a traditional, standard Grayson title on somebody who's never done owner financing, you're going to run into frustration and problems. I guarantee it. Now, the caveat to that is, if somebody's willing to learn about that, in a title company because they recognize that it's a good business to add to get into the owner finance market like it is right now, then that's okay. Educate them and find somebody else who can help them educate and run the numbers. Run the numbers and the details, the biggest thing. For all of these, find these professionals that have experience with wraps, owner financing, notes, insurance agents. All of, when you find people that have done it before, most of them have already been through the school of hard knocks and found out what not to do. Okay? And you as a real estate agent or broker or whatever it may be, real estate investor, they're going to save you a lot of headache at the transaction time as well as on down the road. Because there are a lot of details in this business, a ton. And if you don't pay attention to every single one of them, one of those that you overlook is going to come back and bite you. And it's going to be a drag. I don't mean to scare it, but I mean that's experience for me too. I had to learn that a little bit the hard way as well. Back to that guy that had all the cash and doing his partner. Well, I had a title company that I will never ever use again in Garland try to close that transaction. And that's where leading right into the next thing of documentation and original documents. We wired the money up to that title company. The closing agent came in and says, okay, everything, check out, sign this, everything. Gave that guy the check, and he left with the original promissory note. The original promissory note is the gold in the paper. Not a copy, but the original. Don't lose it. Put it in a safe, findable place. I can't tell you how many note transactions that I've had where all of a sudden, oh, that's not the original? And I just, I literally throw up my hands because I put a lot of things in. Because most investors, you don't have that original, we're not doing the deal. Sorry. That's all there is to it. See you later. Now, I did have one transaction, and this lady was a snake in the grass, and she didn't have the original note. She actually took a copy of the note, got it certified, got a notary, went to the payer's house, and said, hey, will you please sign this? The buyer actually accepted that. And sometimes that works. But if that's a savvy buyer, they may start out, hey, I'm not going to sign this here. I'm not going to even pay you another payment until you produce that original note. And if, that would hold up in law too. Now that's a very fine line, but there were some deadbeats up in Ohio who, guy lost his job, got a big severance package, started his own business, it failed, then he quit making his payments to the bank. I think it was Citibank. And for all intents and purposes, everybody in that courtroom knew that he was responsible for that mortgage, that he and his wife were supposed to make those payments. But Citibank had sold that particular note 10 different times over the course of however long he had it. And his attorney said, show me the original note. We'll make restitution or bankruptcy or whatever it was. And they couldn't do it. So the court forgave the whole mortgage. And the thing about that is the courts no longer took what the bank said for granted. Mr. Bank, we're going to believe you every single time. That didn't happen. We're going to go over here and listen to Joe Homeowner over here, which is a very different tune than it was 5 years ago.
How does that coordinate with the deed of trust that's on record?
The deed of trust, you can go to the courthouse. Now, I like to have the original as well there, as original the mortgagee title policy in a loan transaction. No, you need all that. But the deed of trust is not, it's important, don't get me wrong, and a lot of buyers say, hey, I need the original deed of trust. But you can go down the courthouse and get a certified deed of trust, and they will accept the certified deed of trust. But the promissory note doesn't get recorded at the courthouse.
But the deed of trust is not enough evidence to show that the note existed?
Well, the deed of trust you can replicate. You can get a new certified one from the courthouse relatively easily. That's why.
Certified filed and it references the note.
But that would have been, if you're talking about the case in Ohio, that would have been in relation to Citibank. It had been assigned 10 times, and those assignments would be the
Yeah.
documents they would need.
Even though it references a note, they got to show them the original right there. And the biggest way to know if you have an original of a note document, does anybody know how to do the original test? Anybody? Take your finger, wipe it, on your tongue and wipe it on the signature. If it smears, it's the original. And if it doesn't, it's a copy. That's how they check it at all the different title companies. Let's see, what did I pay or credit? This is always a big, especially with note buyers that are on the national stage for me. Their sweet number pretty much is 600. I have, one guy or one firm in Arizona that they'll buy notes, anything with the pay or credit over 600 on all 3 credit agencies. If it's below 600, meaning if it is $599, don't even come to me with a story because we won't consider it. Only 600. But then again, with us, the Texas Note Company, don't let it intimidate you because as long as it has a good story, I can find a local investor who would, maybe not pay you top dollar that the guy out in Arizona would, but still pretty good price to where you'd be happy with it. There. Now, one of the things that's really changed in the note business for me with these investors is always the story about the payer and their ability to make the future payments. So without pulling credit, you really don't know what their credit score is. I don't necessarily believe that statement because you can turn around and say, okay, is the payer a husband and wife who both work? Yeah, he's a plumber, she's a housekeeper, okay? Okay, well, how long have they worked there? Well, he's worked there for about 10 years and she's been a housekeeper for the same period of time. Where are they? What's their age group? Were they 20s, 30s, 40s, 50s? They're in their 40s. Okay, do they have kids, grandkids? Yeah, they have grown kids with a couple of grandkids, so very family oriented. Do they pay their taxes on time? You pull it up, yeah. Taxes and insurance are totally current. Okay, what kind of car do they drive? Well, they had this brand new Ford out there that's pretty nice that they bought about 6 months ago. Logical reasoning tells that this person probably has decent credit, that they're okay. They do that. That's kind of the thing that we do. Now, the other scenario, okay, is the payer a husband or wife? No, she's a widow. How old is she? Well, she's in her 70s. She wants to sell the note. Yeah, she's ready to cash out. She wants to go on a cruise. Taxes and insurance, right? No, the insurance is paid, but the taxes is just a little bit behind. Okay. What type of a car does she drive? Well, her kids drive her around all the time. Okay. So you're talking about a 70-year-old widow. You're buying a note that still has 20 years left on it. What's going to happen if, she passes on? That's kind of a morbid thing to think about, but that's what I get from these guys, these people buying notes. Find out what the story is here, and that's where they will assess their credit valuation. Now, I had a payer who, was exactly that. She was a widow and she was in her 70s, and her kids drove her around all the time. I actually was able to get somebody to pull her credit. Her credit was 689, but because she was a widow and everything else like that, that particular buyer, he said, no, I'm not gonna do that. That's just not allowed. And that's not sexist, racist, or anything else. That's just kind of a matter of factual. Although, in the workplace environment, you can't ask those questions. Here, you can. And that's just kind of logical reasoning. And when you listen to their answers, because a lot of people call me, okay, Robert, here's my note, I got it. Tell me about the payer. Tell me what they do. Tell me how they're involved. That's the story that I want, because that's the story that everybody's going to start with who is an investor of notes.
Robert?
Yes.
I mean, if it was a $20,000 loan on a $100,000 property, I mean,
Well, yeah, I would get that and say, let's hope she defaults. Now, when I first got, in this business, everybody has a mentor. I got a mentor too. And this guy is up in Colorado. And he told me about a note purchase that he had one time where he actually bought it at par. Because you had some, well, for lack of a better word, jackass. You know, he comes from a family that had a lot of money and he abused it, so they didn't give him any more money. But through his grandfather's will, he got this prime piece of property that was worth almost $1 million in San Diego on the coast. You know, it was like 1 or 2 acres. And then he turned around and wanted a new car or truck or something like that. And he wrote a note against it for like $80,000. You know, something like that on $1 million piece of property. And his credit was horrible. And this guy said, man, I bought that right away. You know, because if he you know, because he didn't even pull credit, he didn't do anything. But that's an $80,000 note with a $1 million piece of property. I hope this guy defaults. So yeah, I mean that's a rather extreme, but very few far between.
So your investors are buying other than purchase money mortgages?
My investors primarily buy deeds of trust tied to real estate. Now they will. There's some that, and I've actually never sold one of these, but you know there's some that will entertain the thought of a business note.
Well, no. My question was purchase money mortgage. He inherited it, so number one, he didn't purchase it. He borrowed against it, so it's a refinance. So
Yeah.
it's not a purchase money mortgage, but it is a mortgage. So.
I don't know the answer to that question because I haven't really done it. I just know that this particular extreme situation, he jumped out with hardly even saying no.
Well, and it makes sense, but
Yeah.
if we're out here doing this, we need to know, is it a purchase money mortgage that we need to create? Because what if someone comes to me and says, well, Susan, you know, can you find someone, can we create a note, you find someone to buy it, to free up the cash flow, to do this, to do that. And so I've always
Well,
stuck
you
with
bring
purchase
it, yeah,
money mortgage.
right. You bring up a very good point, and I think the answer to your question is yes. So look at that. The other item that I didn't mention here, actually 2 other items, is they like to, you know, the other item that I have to provide to the buyers is the chain of sales price. Okay, so you have the seller. Okay, well, when did he buy the property, and how much did he buy it for? Did he buy it, you know, 6 months ago, and this is just a fix and flip? Some of the investors won't buy fix and flip paper because they're worried about the legality of it. So I have to provide the chain of sales price. So now in this case, hey, he inherited from his parents. It's been in his family a long time. He's just ready to sell it, be done with it. Yeah, sure, they'll go for that. That's not bad. It's just some of the places, you know, where they're looking at the foreclosures. The guy in Houston that I use, he doesn't want to buy paper that's been foreclosed on. He's just, with the litigation all around foreclosures, he's going to shy at that.
So he wants 12 months standard title, 24 months?
Yeah, he's going to want, if it has been foreclosed on, period, he's kind of shy, but if they purchased it and have had it for a year or 2 years, I think I can get him to listen. Now, the other thing is that I haven't really mentioned that affects the value of a note extensively is the appraised value of the property. Now, I've seen the appraisal kill note deals because, you know, like we sold the home for $139,000 out in Maynard, yet the appraisal comes in at $115,000, okay? So most investors are only going to offer up to 75% of the appraised value of the property, which could greatly affect the amount of, you know, money that you get out of your note if that's the case. Because they want to be able, if the payer does default, they want to be able to get their money back. And if they can't get their money back, you know, and they take for granted that, you know, no, it's not $140,000. Now they're close to being, you know, losing money on the transaction if in fact they have to do foreclosure, because now they're not getting the cash flow that they expected to receive each month. Now they're having to foreclose and they have attorney fees that go on with that, but if there's not enough money there to cover that, then they take a loss. So they try to be close to it, yes.
Are you doing a drive-by appraisal, or are you doing a BPO?
BPL primarily is what we do, and, you know.
And that's for the first 12 months, the appraised value of the sales price, whichever is less?
Yeah, what I'll do is I'll look online at a few of those websites like Zillow and just to get an idea. That's more like putting your thumb up in the air and see if the wind's blowing the right direction. I will look at the county appraised value of that. That's usually a really good thumb to make sure that, you know, they're paying taxes on the appraised value that at least matches the sales price of the property or is more. And, you know, a BPO we've ordered several times, and that's a lot of times that's up to the actual investor to order, and that's their cost of doing that. So I've ordered a few of them. We've also ordered actually a full-out appraisal where they go by there and actually do all the comps and stuff.
We have to get the buyer's permission to go on the property though, right?
Yeah. Mhm.
Yeah.
Yeah. Ronnie?
When you're creating a note, you have to have authorization to run credit, and if you don't have it, does it affect the note payment?
Well, there are two ways to handle that. A, you can get the authorization and run the credit. You know, I do that over with Heather Mall, and she just give her that, and then she runs it. Or tell your payer, your buyer, say, hey, go out to truecredit.com, sign up there, and pull your credit report and bring it to the table. You know, and it better be above 600. If not, we need to have a discussion. You know, and that's the other big thing along the payer credit here. Make sure you know what you're getting into with the payer, because you know some people can put up a really good front and have just absolutely horrible credit, and then all of a sudden you're in a stigma where you're not getting the expected payments that you deserve. So ask the logical questions. Yes.
Where did you say to tell the payer to go, something.com?
TrueCredit.com is the one I use. I mean, there are a bunch of those different places out there like that.
Does it need to be a tri-merge?
Sorry?
Does it need to be a tri-merge or all in?
Well, True Credit will give you all three.
Right.
Yeah.
Well, I know they will, but
Yeah.
does the investor need all three?
I would say they would, you know, because, you know, each one of them kind of catches something a little bit different that the other one doesn't. And order the full, yeah, I guess the tri-merge is the way you.
Hey, Clark, I would say you could get a free one, freecreditreport.com.
Yeah, just make sure that you get all three. He's right, and the history of that. And then that's pretty good. I think that's it. I think that's all I had for today.
Anybody else have any questions?
Yeah, absolutely.
I have a quick question. One day we were talking about notes in here. There was a suggestion that you maybe divide them up. So like if somebody, say if it's an owner finance deal, maybe they own the place outright, whatever.
Mhm.
And instead of just having one note for $250,000, maybe there's a note for this and a note for that and whatever. So
That usually
you know, so you
deals.
sell off, like if at some point, okay, I want 50 grand, I need some money, I can sell that note.
Yeah.
Do you do
Let
it
me give you
like
a
that?
scenario,
Yeah.
because I'm the one that did it.
Okay.